You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, that rockin' tune means it's time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down the mysterious and sometimes confusing world of options in very simple, easy to understand, easy to digest nuggets that you guys out there in the active retail stock trading community, maybe you're dipping your toes into the options waters, that you guys can take and use in your own portfolios and indeed in your own trading. My name is Mark Longo, your host for this glorious adventure into the realm of options. And where can you find, of course, all of our we have so many great episodes. If you're tuning in for the first time, and I know we've been remiss in getting more boot camps up there for you. Don't worry. We'll get more going up there on a more frequent basis for all you guys writing in. And B, I know a lot of you guys are discovering the show for the first time. And if you're in that category, where can you find more? Well, of course, a lot of great places. We, of course, have them on the mothership, the flagship, theoptionsinsider.com. Click on the Insider Radio Network tab, and you can pretty much download and stream all the episodes right there for you on the website. Of course, iTunes, TuneIn, Stitcher, pretty much wherever you like to find your favorite podcasts. Also, our mobile app available for iOS and the Android and even the Amazon platform. So again, no shortage of ways for you guys, if you're just tuning in here into our latter episodes, to go back and check out the archives. A lot of great episodes, and pretty much they stand the test of time. A call many years from now, so you can tune in and get some learning on, even if you're just picking up the show for the first time. And joining me on the old program, as usual, my fellow Options Bootcamp drill instructor, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the Options Bootcamp drill instructor proving grounds. It has been too long, sir.
Hey, Mark, it has been a long time, and it's great to be back. We've got lots of stuff to talk about.
We have quite a bit to talk about. Do you have your hat and whistle, sir?
Indeed, I do.
All right, then let us get started. We thought, what better way to welcome back the old boot camp program than by addressing you guys directly. You guys have been writing in en masse since our last episode, and we've been so busy we haven't had a chance to catch up with it. So we thought, what better way to tackle a new episode than by tackling all, or at least as many of your questions as we can get to in this extra special mail call Palooza.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. I always feel so festive when we start this segment. I don't know why. I feel like it's July 4th all over again. I wonder why that could be. Anyway, this is the mail call segment. Like the man said, this is the portion of the program where you guys get to make your questions and comments known to Dan and myself. Of course, no shortage of ways for you guys to do just that. Reach us on the website at theoptionsinsider.com, the contact form, or indeed post a comment there. Hit us up via email, questions at theoptionsinsider.com, or find us on social media. We are twitter.com/options, facebook.com/theoptionsinsider, or just Options Insider on Twitter. On stocktwits.com. So no shortage of ways to reach out to us. A lot of that is baked into the mobile app as well. So again, if you have a question, let us know. We love to hear from you guys. At the end of the day, the reason we're doing this show. And Mr. P, are you ready to answer some questions?
I am always ready to answer some question, Mark. Let's do this thing.
All right. There's so many, I'm almost overwhelmed as to where to begin. I guess we'll just start at the top and go from there. This one comes from Tennis Great. I like that handle. He, or perhaps she, writes, hey, this is for the Options Bootcamp show. Well, first off, you passed the right test. You sent it to the right show. He goes on to write, hey, can you give me examples of managing positions using Greeks, and is it a good strategy? Your show is awesome. Well, thanks for that. First off, we love all the love. Keep sending that our way. But the first part of your question is an interesting one. Managing positions via Greeks really is kind of the way it's done. We look at people, professionals, active retail. I don't care who you're looking at. When they're looking at managing your positions, they're tracking their risk exposure. Typically using the Greeks as their metrics, as their variables to keep an eye on. They're looking at, of course, their delta, their gamma, their theta, their vega. Not so much rho these days, though maybe we can talk about that down the road. Rho maybe creeping into our future, maybe in 2016. Doesn't seem like it's on the table right now. Rho, of course, being interest rate sensitivity. Delta, of course, being the big one. That's the option sensitivity to movement of the underlying. And then, of course, gamma, the rate of change of your delta. Theta, indeed, very important. The time decay, the rate of decay of that options price as the rate date to expiration approaches. And, of course, vega, the options sensitivity to volatility. All those things being very important. Now, Dan, when you and I were market makers, we were primarily trading a strategy called delta neutral, which is we would try to wipe out. We would try to eradicate our directional exposure, our delta exposure. Hence the term delta neutral. So if we had a position that was, let's say, long 1,000 deltas, we would sell those deltas off to make our deltas zero. So we would really be primarily focused on managing our vega and, of course, our gamma and our theta. But vega being the main way you'd make money, also theta being an interesting way if you were a short premium trader as well. And so that's just one example of the way a lot of pros do it. They really try to wipe out and eradicate delta and look primarily at their vega exposure. That's really where you're going to make the lion's share of your dollars in that type of scenario. I've said many times here on this show, retail tends to kind of trade the other way. Retail tends to be very delta centric, so they don't really even tend to look at vega. I mean, they look at the price of their options, but they don't really look at, say, hey, this is a 45% implied volatility, and therefore I shouldn't be buying it, or I should be buying it, et cetera. It's much more price centric and much more directionally focused, particularly around earnings and things like that. So for the retail folks out there, delta neutral doesn't make a heck of a lot of sense for the reason I just mentioned, as well as, of course, for the fact that it takes a large account size to be able to hedge your deltas away. You have to have a lot of excess capital. You have to have favorable margin treatment. You have to make a lot of adjustments. You're constantly adjusting if you're delta neutral. You're selling stock or underlying, whatever it may be. You're buying underlying. You're doing a lot of hedging and adjusting. And that's expensive, generates a lot of commissions, and you have to have a lot of capital to do that. So delta neutral is not exactly the way I'd recommend for a lot of the audience of this show, but it is a primary way people use their Greeks to really manage their positions and go forward. But there's a lot of ways. I mean, that's what the Greeks are for. And Dan, I can't think of a better person to answer this question as well than you. I'll give you a chance to chime in. Dan, in addition, of course, to being the founder of Market Taker Mentoring, also wrote a very often read tome on the Greeks on this very topic. So, Mr. Passarelli, what do you have to say to our friend here, Mr. Tennis Great, who wants to know about some examples of managing positions using the Greeks, as well as, at the end of the day, is it a good strategy?
Yeah, it's a great strategy. It's really important. And like Mark said, that's exactly what all professional traders do. Looking at your P&L diagram and just hoping it stays on this side of the break even is not professional. So you're asking about managing positions with Greek. So I'm going to speak in the context that, hey, you put this position on. Now, how do I use the Greeks to manage? There's tons of ways, the one thing might be to one of the most obvious things that comes to mind is planning your exits. If you're trading options, which are derivatives of an underlying, and the major thing that affects the value of any option position is delta. That's sort of the most influential Greek. If I've got this call on or put on or call spread or whatever it is, and it has a delta associated with it, well, hey, if the stock ends up going through support, well, that's where I want to get out, maybe. That's a very common way to look at exiting a position. Hey, if we bust through support, the trade's no longer valid. I want out and I want to cut my losses. Well, that's all fine and good, but if the stock gets to price X, well, what price is my option going to be worth? Because that's what I'm going to be trading. I've got to put a limit price in on my option position, not the stock position. So I need to use delta to figure out, well, what's my option going to be worth if the stock goes to here? And that's just a simple approach. That's if I look at it today, what if this happens 4 days from now? Well, then I got to factor theta in. And if it's a big enough move, well, then implied volatility might change. Implied volatility might rise if the stock goes down and fall if the stock goes up. So I've got to factor vega into that exact same equation. So, I mean, I could sit here and that's one example. I could sit here and give you a million examples, but the concept is that you use the Greeks to anticipate what an option price will be given certain changes, and that helps you plan your exits, helps you plan your adjustments, help you plan whether you want to stay in the trade or not as well. So, yeah, I mean, it's all really important.
So I love the questions on the show. We could probably spend the entire show just answering this one question. There's so many variations of how to use the Greeks to manage your position that it's kind of a daunting question. By the other hand, people want their questions answered as well. If you are interested in this subject, maybe perhaps this is for you as well. Tennis great out there. Hope your tennis career is growing very well. Check out Dan's book. Give him a free plug here. It's called Trading Options Greeks: How Time, Volatility, and Other Pricing Factors Drive Profits. You can find it on Amazon. There's even a Kindle version there if you don't want the hardcover. If you're like me, you're into the old digital paper, the e-ink these days. You can check it out there as well. So that's, of course, you can really spend some quality time with the old Greeks. A great question. Again, that's just a few examples. There are many, many myriad examples of how to use the Greeks to manage your position. At the end of the day, you want to make sure you are doing just that. You are using these risk metrics that are provided for you, typically by your broker. You can look at them and say, you know what, hey, I'm getting a little risky here. I have some downside here, whatever the case may be. And you could use those to really try to effectively manage your risk. That's the goal at the end of the day. All right, good question. Moving on to another one here. This one comes from Pedro I. He writes, hey, question for Options Bootcamp. I discovered the podcast within the last week, and I'm already up to episode 8. Well done, Pedro. I know we have a lot of guys and gals like you out there who are discovering the show. Still, we see it. Even though we've been infrequent in our new episodes, it still gets a lot of love out there in iTunes and other places because it really is a great, fantastic free resource for people like you to really get into options. He goes on to write, hey, I understand how overall market and industry direction might influence a stock's direction. Is there something similar regarding volatility that can be observed, where an overall sentiment might influence or work with an option's implied volatility? As a new recruit, wonderful educational basic training, sir. Well, good question here, Pedro. Again, these questions are great, and they could each be almost an entire episode in and of themselves. We'll try to condense them so we could answer a few more questions here on the show. Is there something similar? Well, we talked. You guys are stock traders out there who are probably listening to this show, coming to options from the stock world primarily, maybe some futures guys, mostly stock. You understand things like whispered numbers and earnings and how future sentiment, future analysis, upgrades, downgrades affects the price of a stock, how it makes it move up and down. So we don't need to get into that. On the option side, it's a little bit more nuanced, a little bit different. Obviously, we're just talking about the Greeks. There's the straight up directional effect where if something is downgraded or something like that, or they underperform earnings, the underlying is going to drop. And then, of course, the options are going to move accordingly. That's a pretty straightforward move. What he's talking about is more of a somehow sentiment in the future, with the underlying maybe not really directionally moving, may be showing up in the options. And there's a few ways he's mentioned that. He mentions options implied volatility. We see that a lot going into events, times where the market knows there's going to be volatility coming up, and you see it starting to increase. Things like earnings reports are a classic example of that. Going into an earnings announcement, you're always going to see an increase in implied volatility, 9.9 out of 10 times, just because that's pretty much what the market is expecting. They don't know what's going to happen. They know something is going to happen, and they're pricing that into the options price. That's kind of the most basic way we see this kind of sentiment reflected in options. You can get things that are a little bit more nuanced. Perhaps the market is starting to be concerned about a correction in an index like we're seeing right now. The market is selling off aggressively as we're recording this show, or at least it was today. We're seeing a bit of a rebound. Or, of course, you could be seeing maybe perhaps an upside move prediction in the underlying. That's going to be a little bit deeper to dig out. You're going to have to look into what we refer to as the options volatility skew. If you don't know what that is, go check out our episode where we talk all about that fun stuff. But essentially, those are, of course, the calls, which are the out-of-the-money options to the upside. The puts are the out-of-the-money options to the downside. And what type of activity is really going on in those? If there's a lot of pronounced bearish sentiment in the future for an underlying, you're probably going to see an increase in interest in the puts in that name. So what's going to happen are those puts in whatever time frame we're talking about here. It could be a few months, could be a year, whatever the sentiment is saying. If it's near term, it's going to be in the front month and the front couple of weeks and the front few months, perhaps. You're going to see just an increased level of volatility in those puts. People are buying them, so they're driving up the level of volatility in those because they want hedging, they want to speculate on a downside, whatever the case may be. They're concerned about downside, so they're buying puts. You'd see the exact same thing play out perhaps if there was perhaps rumors of a takeover in a name. You see this all the time. You don't know when it's going to happen, but there's rumors perhaps company A is going to take over company B. Well, guess what? You're going to see a flurry of upside call activity, and there's going to be a heavy bid to those calls. Those calls are going to get much more expensive from an implied volatility standpoint than they would be normally, and you'll see that play out there in whatever expiration cycles people are thinking this event might take place in. Those are a couple of the most obvious ways that you see this type of sentiment playing out from an implied volatility and a volatility skew perspective. Mr. Passarelli, again, these questions, we could probably spend a lot of time on each of those, but do you have anything else you want to add for our friend, Mr. Pedro I, who is a new recruit to the Bootcamp program, but already when he wrote this in early August, he was already up to episode 8. He might be caught up to all of us by now, so we like these kind of guys. What do you have to say here from Mr. Pedro?
Yeah, actually, Mark, I think you forgot the most obvious one, the VIX. The VIX index, well, think of it this way. If you are concerned about stock direction, you're a stock trader like Mark was just talking about, well, what do you do to get just a sort of general sentiment about what's going on? Well, you look at the S&P 500. Hey, are stocks up today or are stocks down today? In general sentiment. If you're an option trader and you need to know, well, hey, are options overall cheap or expensive? Well, look at the VIX. The VIX is the implied volatility of the S&P 500 options. So, you're doing the exact same thing as a stock trader would do by looking at the S&P 500 to get a general market direction sentiment. You're getting a general market volatility sentiment by just observing the VIX index.
Good old VIX. Maybe I just subconsciously omitted it because I talk about VIX so much in so many of our other programs. I don't want to bring it on here if I don't have to. Of course, if you're confused about what we're talking about, volatility skew, implied volatility, VIX, etc., again, go back into the archives of Options Bootcamp. We have many episodes devoted to these topics. What is volatility? What is volatility skew? What is the VIX, etc., etc.? We go very deep into those if you'd like to learn more about that. But yeah, Dan is right, of course, for a very broad gauge of market sentiment. Sometimes it's bandied about a bit incorrectly or not really understood when it's bandied about as the fear gauge at places like, CNBC and others. But that said, if you want just a general gauge of perhaps what's cooking in the market, the VIX is not a bad place to look either. So great question again, Pedro. Congratulations on discovering the program, and good luck on your future options endeavors, sir. We hope to hear from you again soon with all sorts of success stories from you as an options trader. All right, next up, we have we like the general questions here, Mr. P, or at least our audience likes to send in general questions. This one comes from TopStep. They write, hey, why would we use options in lieu of futures or other underlyings? Well, that's kind of the reason why this show exists. Why do we like options? Why have Dan and I committed ourselves to the realm of options? Why do options attract us more than any other product out there, than stocks, than bonds, than futures, as they mentioned, which are also, I should say, a derivative product? Well, because options, they offer so many advantages that those products do not. We talked earlier about the Greeks. Those are risk metrics that are unique to options. So So in that sense, at least, of course you have delta for futures, but the rest of that fun stuff you don't get. So options, a lot more sophistication you can do from a risk management perspective. Of course, the most basic reason a lot of people like to get into options is, of course, the leverage. You can come in and speculate on an underlying or hedge on an underlying, and I have to outlay the tremendous amount of capital it would take to do that in the stock. Futures, also a leveraged instrument, but if you know what you're doing with options, you can put them to use much more effectively. And also, the thing that really attracted me to options, and Dan, I'll let you weigh in with what attracted you as well, but the thing that caught my eye, that lured me to the dark side, say what you will, is just the mutability, the adaptability of options. When you're trading options, to say you're trading options is kind of a misnomer. You can really be trading whatever other product you want using options. If you want to trade a stock using options, you can do it. If you want to trade a future using options, you can do it. If you want to trade a bond, you could do it. You can create pretty much synthetically just about any underlying you can think of using options. And that's an incredibly powerful thing. And you can create an advanced series of spreads. You can really mitigate your risk in a very, very sophisticated way if you know what you're doing using options. So all of these things just make these products very attractive to me. At the end of the day, even more than the leverage and the other things I mentioned, it was really the adaptability. No matter what the market scenario is that you're looking to trade, there is an option strategy that will fit it, or you can create something of your own to fit that. And that is something that is unique to options. You don't really see that in stocks or futures, which you can kind of just be long or be short, and that's kind of it. It's very binary in that sense. Options are by no means binary. They are all over the place, and they can really be adjusted to suit whatever outlook you have and whatever market scenario you're looking to trade. So, Dan, that's what brought me to the dark side. What is it that really attracted you to the world of options, that got you over there at the SIBO, got you writing books about options? What is it that really brought you over to the dark side?
2 words, baby: risk management. Futures traders and stock traders, look, here's the thing. With futures trading and stock trading, they're thought to trade logarithmic, right? And so logarithmic, it's kind of like a bell curve. And basically what that tells you is that, well, most of the time stocks and futures don't really do anything, but every once in a while they have a huge, gigantic move. So, because most of the time, there's small moves or there's medium-sized moves, stock and futures traders think, well, I'll just protect myself by using a stop. Okay, so we're recording this here on August 25th, which is the day after the Dow Jones Industrial Average dropped 1,000 points in the morning, which included opening hugely lower. How did your stops work out for you yesterday, guys? They work out pretty good? No, the answer is no. You got your behind handed to you if you were one of these guys who confidently and in a very cocky sort of way says, I don't need to protect myself with options. I'll just use stops. Well, you got your butt handed to you if you're using stops. And you're scratching your head going, why? Oh, well, it must be somebody else's fault. It's the Fed, it's the market makers, it's the media, it's the Chinese, it's somebody's fault. It's not mine. I use stops. Well, no, you're irresponsible if you use stops, because every once in a while the market gaps lower and they don't work for you. They're not designed to protect you against that. But with options, you do inherently protect yourself against gaps, overnight gaps, because you have limited risk and you're able to trade in a way that gives you limited risk, that gives you high probability of success potentially. You can trade in a way that gives you an extra edge besides being just right on direction. You can also add volatility analysis to your side that gives you greater reward potential, lower risk, and higher probability of success. So options give you risk management. They give you much more flexibility. They're harder to understand, which is what causes a lot of people to shy away from them because, who wants to put in all that effort to learn all this extra stuff? But with trading, and like most things in life, the more effort required, the more benefit to you. And frankly, I think it's easier to make money trading options than it is trading stocks or futures because of that.
My favorite are the money managers out there who should know better, and I've encountered many of them, and I'm sure you have as well, Dan, in your travels, and you'll talk to them about, hey, do you use options to hedge your primarily long equity portfolio? Oh, no, they'll do what you said, Dan. They rely on stops or some of the even more, shall we say, self-confident of them. Oh yeah, I just rely on myself to my own signals to when I want, it's pretty much my own trigger finger to when I want to get out. And how's all that working for you on a day like yesterday? Again, Dow down 1,000 points on the open, pretty much. Not a lot you could do if your precious signals didn't warn you ahead of time, and how many of those actually did. So yeah, it's an interesting one, and that certainly is a good use case as well. At the end of the day, options are kind of the only game in town on days like yesterday when the rest of the market is heading for the hills. There's no liquidity in anything. Your options hedge will be there for you, and that's a good thing. That's a thing that lets you sleep at night on days, even on mornings, even like yesterday when everyone else is up and biting their fingernails and saying, oh my, the sky is falling. All right, moving on to our next question comes from, I like this handle, Steamboat Willie. And he or she, I'm going to guess he writes, hey, what would you say is the best buy and hold strategy using options? I'm interested in using some options in my retirement account, but I don't have the time to manage them on a daily basis. I like to put something on and only check it every few weeks or months. I'm mostly interested in large cap stocks, although I'm not adverse to dipping my toes into alternative assets such as oil. We get a lot of variations on this theme here on this show and other programs on the network. People like to trade options in their retirement accounts. It's a very primary use case for them. I think I saw some data recently coming out of the OCC, the Options Clearing Corporation, that upwards of 15% of retail volume is retirement account options volume. So that's a pretty substantial amount of your typical ADV out there going into retirement accounts. And lion's share of people out there are pretty much just writing covered calls on their long stock positions. Some of them putting on collars, buying a put, selling a call, trying to do that on a cost-effective basis. And you could certainly do that. That's a pretty effective way to go if you want just to set it and forget it. You find the zero cost or closest to zero cost collar you can create in whatever month you like. You have your underlying, and then you just kind of set it and forget it. And that is easy, but again, when you're doing setting it and forget it type strategies, the level of efficacy is going to be really going to get what you put out of it, what you put into it. And in this case, you're not putting a heck of a lot into it. So I've always kind of said zero cost collar is not perhaps the best way to go. You're better with a little bit more active management. You can also do a couple other things to juice up your traditional boring stock in the IRA account. I'm a big fan of using the stock replacement strategy. If you're unfamiliar with that, check out our detailed episode on that here on Options Bootcamp. Long story short, you're swapping out your stock position with a longer term, probably a leap, at least 1 year, in the money call, so a meteor call, probably somewhere in the 70, maybe 80 delta range. So it's not quite stock, but it's pretty close approximation of it. And by doing that, just remember we talked about leverage benefits in the earlier question. Just by doing that alone, if you do nothing else, you've added a lot of benefits to your portfolio. You've reduced your outlay for a position that is essentially approximate to what you just had. You're spending a lot less money, putting a lot less capital to work to do that. You're getting all the Greeks to work for you now. You get delta, so if the underlying drops, that delta will decrease. You will lose money. You still lose money, but you'll lose money slower. Your rate of loss will decrease. You'll have volatility that will increase as the underlying drops, so that will help offset some of your losses. It's just a more demonstrably beneficial position than just buying the stock itself. That's a simple set it and forget it thing you could do. Swap in the leap for the stock, and now you're pretty much good for a year, and whatever happens to the stock happens to the stock. That's very basic. You can add on a layer that I like. You say you don't want to do it every few weeks or months, or maybe you do it quarterly. That might be a way you could do it. It's not going to be the most effective way, but you could still do it. Now you have this leap option position in the money call position, and you can turn around and essentially sell a quarterly covered call against that. And now you're generating income. So in addition to the benefits I just listed of saving money on the outlay for the stock by buying the call instead and the Greeks and everything like that, now you're adding an income component to that. And that's going to offset, again, some of the cost of that call you bought and effectively create a dividend stream on this position that you have in your underlying. So that's one of my favorite positions to put into an IRA account. Again, it's up to you how much management you want to do. If you want to go crazy, you could sell weekly options. If you want to be a little bit less active, you can do monthly. If you want to do even less active, you can do quarterly. Again, the level of bang for your buck you're going to get is going to be pretty much directly proportionate to how much time you put in. So if you want, and of course, you talked about selling covered calls and theta before. You want to be closer to that front month portion of the curve. curve, so you probably want to be around front month at the farthest out when you're selling those calls. But again, I'll leave it up to you how you want to structure it. But that's one of my favorite positions to put into an IRA account, using options and indeed stock and swapping them out. Mr. Passarelli, you probably spend a lot of time working with your students, your mentees, your clients over there at Market Taker on this exact topic. What is your favorite use case for options in a retirement account?
Yeah, I mean, in a retirement account, you're somewhat limited what you can do. You know, you can't be selling naked calls and, 1x2 vertical, ratio verticals.
Wait a minute. I need to go call my broker. Excuse me.
Yeah, exactly. So you're limited, and that's fine, because in your retirement account, it's a very different strategy than in a trading account. You know, you're overriding concept of that retirement account is owning equities. And so option positions that either help you to buy equities at a better price or sell equities at a better price is what you use. So it just goes down to your classic selling cash secured puts or trading covered calls. I mean, you want to get fancy, you could do both at the same time, sell what I call a covered strangle, where you actually do both, which is an interesting strategy we can talk about on a future episode here. But, the only one caution I'll give you is if you only want to look at it every few days or once a week or something like that, that's fine. There's absolutely nothing wrong with that. But don't get yourself relying on a strategy where, you're waiting for a day like yesterday to jump in there and sell your puts, but it just so happens that Tuesday or, Monday mornings is when you have yoga and you're not able to look at the market and you miss your opportunity, so you have to do an extra layer of planning if you want to afford yourself the luxury of not being able to, not needing to watch the market every waking moment of the day.
Indeed. All right, next up we have a question comes from Beansy. he or she writes, hey, is there such a thing as a commitment of traders report for options, something that shows bullish and bearish positions in the marketplace? Of course, if you're not familiar, what he's referring to, listeners, is the CFTC, the Commodity Futures Trading Commission, puts out a report on a regular basis on the commitments of big traders in different products, in oil and grains, et cetera. They show how many futures people are long, how many futures people are short, how those positions have changed. And they also break it down by essentially what they call bullish or bearish positions. So they do include options in that rundown. So if you're on the commodity side of the fence, you are covered already. There are indeed those reports, but I have a feeling he's talking more about, shall we say, I don't know, the Apples, the SPYs, those types of products where are more equity focused. And unfortunately, the answer that at least I can think of, maybe Dan has some surprise up his sleeve I'm not aware of, but in general, I can't think of anything that really approximates that in the equity or index marketplace. We get things, there are daily reports come out of places like the OCC, the Options Clearing Corporation, that clears all the trades every day, but that's just pretty much straight up volume. Of course, you have your daily open interest adjustments, so you'll see every morning what the real open interest is on the strikes from yesterday's trading, so that will kind of help you get an indication of what people are up to on a particular underlying or a particular strike. But yeah, unfortunately, there's no, hey, here's the Apple commitments of traders report that is really that does that kind of thing out there. We have other things like 13Fs and stuff that show what insiders are up to in particular names from a stock basis. But yeah, you don't really have that on a regular weekly or monthly basis. Here's commitments of traders in these popular big S&P names or in even SPX or something like that. I agree, that would be a cool thing to have. You have to kind of dig and do your own research through products like Trade Alert and others to really kind of compile your own reports in that sense. And there may be some third-party vendors who maybe try to approximate something like that. But yeah, if I had to recommend a service, I probably would say Trade Alert and go dig into the underlying you're interested in, and you can kind of compile all that data yourself. There's no big regulator out there doing it for you, but you can kind of approximate that yourself if you have access to the services and you kind of know what you're doing. Mr. Passarelli, anything to add for our friend here, Mr. Beansy? I like that handle.
Yeah, no, I mean, that's an interesting question. I certainly don't know of anything out there either. Your suggestion of Trade Alert is a great idea. I mean, it's not exactly what you're looking for, but They sure have a lot of great info. I mean, I look at things a little bit differently, a little bit more situational. Look for rises or falls in implied volatility. Maybe look for option volume under certain situations compared with open interest and that sort of thing. But that's not sort of a broad stroke problem solving thing that you're looking for. So that's all I got.
Yeah, it is a bit of a challenging one. You kind of have to rely on vendors to kind of put your own kind of report together, use their services, find what you like, the underlying you're interested in, and kind of dig into it for yourself. Wish we had an answer for you, but unfortunately there really isn't anything out there like that. If you know of something out there, listeners, that can approximate that, let us know. But really nothing coming from a big agency like the CFTC that you could really utilize outside of what they already do. We got time here for, I think, a few more. Let's go. This is the timely one, Dan. This comes from 999. We seem to get some variation on this question almost every episode, but it seems to be very, very well timed right now. He or she writes, hey, how do you spec on the market falling out of bed using options? Well, Dan, as you just referred to, we're on the heels of a week of just pronounced sell-offs in the S&P and indeed the Dow. And yesterday, which was Monday, August 24th, was the biggest one-day sell-off in the Dow's history from a point perspective, over 1,000 points or about 1,000 points. So that's exactly the type of market we're in right now as we're actually recording this show. So excellent timing. Dan, I've been talking for quite a while here, so I'll let you sink your teeth into this one first. There's a lot of different ways we can probably spend the entire show again on this question. But what is your favorite use case for, let's say, that end of the world scenario, kind of like yesterday, where, oh my God, the sky is falling. I need to get short. I need to get short now. Or in this case, he's actually saying, how do you spec on it? So how do you get set up ahead of time if you are so fortunate to be forewarned of such an event? What's your favorite downside trade with options?
I mean, if you're looking for a big, gigantic move lower, then the best trade that you're going to be able to use is to go out and buy puts. Good old fashioned buy puts, not put spreads that limit your profit potential. Buy puts. Simple. That's it. The problem, of course, comes along where timing is everything. If today I'm bearish because I think there could be a big drop, but that drop doesn't happen for 6 months, I'm going to get creamed on my puts, so there's your answer. And, as far as guarding against, and this is not really where that question was going, I don't think, but I feel the need to bring it up. As far as guarding against a big drop, well, that's something that I spend so much time guarding students and potential students about. Hey, protect yourself. They say, oh, well, I made money selling naked puts for the last 2 years. So, this works fine. Passarelli, I don't need to do put spreads that have limited risk. Hey, I'm just going to keep selling naked puts. And guess what? All those guys who thought they were so darn smart, so much smarter than me because they made money for 2 years. And I told them, you might make money for another 2 years, but one day you're going to get your butt handed to you. And you got your butt handed to you. And now they're cowering in a corner in fetal position saying, I should have listened to that Passarelli guy, and it's not like I'm psychic and knew that this was going to happen yesterday or anything like that. It's just that I know that market's correct sometimes. It doesn't take a master of the markets to tell you that. Markets correct. Look through history. You will see periods where markets fall 5% sometimes, or 10% sometimes in a day, sometimes over a matter of days. So trading, just naked puts in a trading account, not IRA with cash secured puts, that's different. Naked puts in a trading account, you're crazy. And, frankly, you deserve to get it handed to you if you are trading so recklessly.
Mr. P, getting fired up here, sir, on naked puts. I like it. Those those always get your juices flowing. But you're right. It is kind of a boring answer to say buy puts. We get asked this question all the time. I'm sure we're going to get a lot more emails on this exact topic after the events of the past week. But yeah, it is kind of the people expect us to come out with some, hey, here's the elaborate iron condor ratio swap strategy you should have utilized at that precise moment. But at the end of the day, KISS is the best strategy. Keep it simple, stupid. And when the market's falling out of bed, a nice put in your pocket is going to be the best thing you've ever known in your life. Short of perhaps just being straight up short the underlying and riding it the whole way down. But we're talking options here. So yeah, straight up put, no put spread, no ratios, no nothing. Just simple works. And if you can get it off in an environment like yesterday where the Dow was off 1,000 points, well, then more power to you. You're a good trader. But yeah, it's kind of boring. But at the end of the day, boring works. When everyone is running out, when the market's too crazy. Yesterday, they couldn't even disseminate the VIX for a half an hour because it was just too wild, too crazy. They couldn't even, the markets were too wide. They couldn't get prices. So in that kind of environment, that's what you're going to be trading in when this kind of question arises. So there's no real luxury to be doing multi-legged crazy nonsense. You kind of got to go in, something simple, and get it done. And puts in that scenario will work, and they will work well. Good question there, Mr. or Mrs. 999. Unfortunately, that's all the time we have for this mail call Palooza here on the old Options Bootcamp program. It's also all the time we have for this episode of Options Bootcamp. I know we wanted to go longer, but we're kind of up against it. But I know you guys have been writing in saying, when's the next episode? When's the next episode? So we want to make sure we got one up on the feed for you. Don't worry. We'll have more coming down the pike for you. But before we go, as always, Mr. Passarelli, what's cooking in the land of market taker you want to let our listeners know about?
Oh, we've got lots of stuff going on here, as always. The summer, of course, is always slow, so we haven't been doing too much this summer, but we are ramping up for an exciting fall. Keep your eye out towards the end of September, mid to the end of September. We actually have a really great class that we're going to be promoting at an incredible discount, the best discount package with bonuses that we've ever offered. So keep your eye on that. Get on our mailing list if you're not already. You can go to markettaker.com and just click on get my free newsletter or get my free ebook. Either one of those will put you on the email list. But you don't want to miss this promotion that we have coming mid to end of September.
Good stuff. Surf on over to markettaker.com to learn more. And on behalf of Mr. Passarelli and indeed myself, I want to thank all of you out there in the listening audience for continuing to download and subscribe and be such devoted fans of Options Bootcamp. We love you all out there, and we'll see you next time for more Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.